Hello, everyone. It's Professor Reiko here. Today we are finishing up kind of our last main topic in the chapter on accounting for income taxes, and that deals with net operating losses. All right. So a loss is basically the opposite of income. So a loss just means you have more expenses than you do revenue, and so on. As far as the tax your return goes, that means you have more tax deductions, tax deductible expenses than you do have than of your taxable revenues or taxable income. All right, so it ends up being a tax loss on your tax return. Okay, so what the federal law allows us is to carry these losses forward to offset profits of other years. Okay, so if I have a loss this year, I can carry it forward, and then if I have taxable income next year, I can use my loss to offset some of that income or all of it, depending on the size of the loss. All right, so what we call this is a loss carry forward. All right, so a loss carry forward is we're using the current loss to offset future taxable income. All right, so FASB considers this because it is future tax savings. We're going to treat it as a deferred tax asset. All right, so as the case that we saw earlier with deferred tax assets in this chapter, we might have to use a valuation account if we expect to not benefit from that, but we'll get to that in just a second. All right, so let's look at a quick example here. We've got a company net operating loss of $19,000. We're going to use a 30% tax rate. All right, so typically if we had income, we would have income tax expense and income tax payable. All right, but this year we don't have income. All right, we have an operating loss as far as our taxes go. All right, so what we're going to do is we're going to create a deferred tax asset, okay, because that's what we're doing. We're carrying forward the loss, so we have this future tax savings when we get to use the loss to offset future income. So it's a deferred tax asset, and it's going to be the tax on the loss, 30%. All right, so $5,700 is the deferred tax asset we're carrying forward. And here we are going to credit income tax expense. So usually we debit all of our expenses to increase them because that's their expenses or normal debit accounts. But here we are going to credit this income tax expense. In your book, the QSO book just puts in parentheses carry forward. So you can just put a little dash carry forward or something like that. And so this is actually a tax benefit. All right. So if we're lowering your income tax expense, that instead of, you think about income tax expense gets subtracted on our income statement. Well, a credit to this or an income tax benefit like this will be added. And we'll see that just in a second down here when we do the partial income statement. So that's it for the journal entry. So we now have this DTA on the books that we're carrying forward. Okay, so now it's sitting there to offset future income. All right, we'll get to that in the next year. All right, real quick though, how our income statement looks. Remember, we had a loss before taxes of $19,000. But now we have these tax savings, all right? So that actually increases income or makes our loss smaller, however you want to say it. And so our loss is now only $13,300. All right, so if we have taxable income the next year, okay? So let's think about this. Just ignore the fact that we have this DTA right now. So if we have $60,000 at a 30% tax rate, we should assume that we'd have to pay $18,000, right? That's if we, didn't have a deferred tax asset. Remember, a deferred tax asset, though, allows us to offset future tax payments. So here we would have had to have a payment of $18,000, so we're going to use our DTA to offset that. All right. So in this part of the chapter, we just assume that there's no temporary differences. All right. So remember, you think about it earlier in the chapter, we would debit income tax expense, and that would just be our plug number in our journal entry. All right, because of the temporary differences. Here, we know it's going to be $18,000 as well, because we're assuming taxable income and financial income are the same thing. Okay, it just makes it a little bit easier. All right, so we're going to use our deferred tax asset, and we'll use all of it up, and then we'll pay the difference. So normally, we would have had to have paid $18,000. But now we're just going to have to pay $12,300. So remember, that's the whole point of this. We're carrying it forward to offset future tax payments. Well, that's exactly what we did here. We normally would have had to pay $18,000, but now we're just paying $12,300 because we use that deferred tax asset. All right, now if the case had been where, let's say up here, our deferred tax asset was $20,000. Well, if that's the case down here, we would have had income tax expense 18, deferred tax asset 18 and paid nothing and still had $2,000 in your deferred tax asset account. So if you get, depending how your professor approaches these with you, it's a good idea, if you have a longer problem, just to go on and set up your little T account for your deferred tax asset and track it as you go. Because if, in the example I just gave, you might not have used it all up. This one's pretty cut and dry. You use up all the $5,700 in the first year. All right. So now let's switch gears and talk a little bit about using a valuation allowance. All right. So what we're saying here is we've made this journal entry up here. Okay. So assume management determined at the end of the year that none of the carry forward will be realized. All right. So we've already made, like I said, we've already made this journal entry up here. All right, so now let's come down here and create the valuation allowance to help offset that. All right, so remember, when we have a valuation allowance, we're creating it in this example. What we're saying is we're not going to benefit from the deferred tax asset. Well, if that's the case, so if you look back up here at this first journal entry, remember, when we create the deferred tax asset, we're saying, if we're going to benefit from it, then that means we're going to benefit it by reducing our income tax expense. Well, now we're saying we expect not to. So what we need to do here is actually recognize the income tax expense for the $5,700. And I think your book puts dash allowance or puts allowance in parentheses. All right, so at the top we had the credit of $5,700 and then the debit of $5,700 here. So it basically cancels it out. Okay, so we don't get that reduction of the $5,700 that we saw in the original example. All right, and then remember that credit from the earlier in the chapter for allowance, it's the allowance. I'm not going to write it all out, but it's the allowance to reduce the deferred tax asset to the expected realizable value. So pretty long account name, but I just let my students abbreviate it like that come test time if they're writing it out. All right, so now we have the allowance on the books. All right, so now what happens next year or just any year, if we have $60,000 in income? All right, so let's just assume it's 2007, just like we had it up here as 2007. All right, and we still have the 60,000 and the 60,000 at the 30%. All right, so if that's the case, we are going to make this entry. So this entry will still be the same. So this journal entry. And in addition to that, we got to remove the allowance. Because remember, now, the allowance says we are not going to benefit. We expect not to benefit from this deferred tax asset. However, now we are benefiting. All right, so notice we still make this journal entry up here because remember, this deferred tax asset, keep in mind, let me scroll back up here. This deferred tax asset is still on the books. Okay, so now we are using, remember, when we create the allowance, we don't reduce that. So reduce the deferred tax asset. Remember, the allowance is the contra account to the deferred tax asset. All right, so now we're realizing it, so we can make this whole journal entry right here, all right, to recognize that we did pay 12.3, we use up the deferred tax asset, but now we need to get rid of the allowance. All right, so the allowance to reduce, because remember, the allowance said we don't expect to use it, but we just did, so we need to take it back off the books and zeroed it out, and then we do that with income tax expense dash allowance. All right, so that's if you have an allowance in a net operating loss problem. That's how you would handle it, okay? So some similarities to when we talked about the allowance earlier in the income tax chapter. I can't remember what video that was, but one of the early ones. All right, so similar to that, we're now dealing in terms of a net operating loss on our tax return. All right, so this is kind of like your last main topic. So, when I think about this chapter, I always tell my students, look, you've got two main things going on. You've got our temporary and permanent differences, which is the big chunk of the chapter, which we spent a lot of time on in the previous videos. And then you have these net operating losses. All right, so the net operating losses after the recent Tax Act got a lot easier because we didn't have to worry about carrybacks and carry forwards. Now we only have to worry about carry forwards. So this part of the chapter to me has gotten pretty easy. But don't overlook it. Make sure you spend some time understanding that. But just realize that the temporary differences at the beginning of the chapter represent what I feel is a bigger chunk of the chapter come test time. All right, so that wraps up our chapter on accounting for income taxes. All right, so just make sure you keep tuning in. Hopefully this will help you come test time. If you have any comments, please leave those for me, and I'll try to answer those as well. Hope your semester is going great, and I will see you on the next chapter.